YouTube, what it do? It is your boy Young Soros here, back with another video. And in today's video, we're going to be going over all the craziness that has been going on within the stock market for the past week. There is a lot of volatility. The stock market is edging lower as we speak, but we are still not in the danger zone yet. There is still a little bit of hope left for the end of the year rally. We still have statistics on our side. We still have that seasonality on our side, but it's not looking good when you have the bonds creeping up to 5% on the yields. You got earnings, you got so much going on. It is going to be a jammed packed week. It is going to be a week of volatility. Get ready for some big swings, some big moves, and if you get the rally or not at the end of this week, that is going to determine what is going to happen going into 2024. So let's jump right into it, starting with the bonds. The bonds have been getting absolutely clobbered ever since July. They've just been on a downtrend and it has not looked back. The bonds have been getting absolutely smashed, and if you take a look at something very interesting, you notice the volume is picking up at these levels. Something very, very strange is going on in bond land right now. It is looking very spooky considering that it is October, but it's looking more spooky than usual. So that is why the stock market has been freaking out the way that it has been. The bonds have been creeping at 5%. If they break 5% and then just continue to run, at that point we are in the unknown. We are not there yet, but right now we are knocking at the doorstep of a very, very bad situation going into not only bond land but also equity land as well. There is a lot that is riding on this, and if you get the wrong things that happen this week, whether that be earnings, economic data, or even Jerome Powell, the ECB, or the Bank of Canada, that will all affect the bonds and how the SPY will move and how we will end the end of the year, whether that will be up or down. Now, if you guys have watched my previous videos before, you know that usually around this time of year it is more bullish than bearish, aka the stock market tends to be higher at the end of the year and we tend to climb out of these periods. But what makes 2023 so interesting is that you have the bonds rising to 5%, and last year you were able to ignore everything. CPI at 9%, inflation at 9%, bonds creeping up to 3.54%. You were able to ignore that all last year going into the stock market rally. Now, coming out from last year, now in 2023, you're not ignoring it the same way you are now. And that also may be because you have oil and energy to worry about, as well as you have the war going on in Israel as we speak. So that could also be playing into it, and the bonds and stuff like that. But this is very interesting that there is so much volume in the bonds. Either something is going to break really, really soon, or you're going to see a massive pop, a massive short squeeze within the bonds. Something is coming. There's guys, when I tell you that volume is key, volume is key. All right. So if you see a lot of volume, especially within the bond land, usually bonds are more stable, but there is a lot of volatility within the bonds. And that's what I want to focus on, is that you got to keep an eye on this. If we go up to 5% in the yields, and if we break 5%, hold those levels, or even go past it to go to 5.25, you are looking at a bad situation for the stock market, and you could easily be at 390, 380 by the end of the year. So I'm still bullish on the market. As of now, I'm not changing my current position. I'm holding bearish positions currently, but I'm still bullish on the overall market going into the end of the year. There is a lot of factors, there's a lot of things that are in the bulls' favor, but you got to keep that in mind. Things are starting to change really quickly, and depending on what goes on this week, you got Jerome Powell speaking. Like I said, you have interest rates from the Bank of Canada. You also have the ECB coming out. You have economic data coming out. So there is a lot riding on this week. This is the make it or break it week. This will determine if I will decide to switch gears and decide to short the market again, or buy everything up. Oh, and don't forget, you also have earnings too. So that could also play into it. And like I said, I still think we're in this little earnings mode where we can ignore everything, but it's getting harder and harder to ignore everything when you have so much going on. And again, this is just really like amazes me how much volume there is in the bonds, especially down at these levels. Somebody is shorting the bonds to an alarming degree, or somebody is buying the bonds at an alarming degree. So you got to keep that in mind. Watch the bonds. The bonds has to be your number one focus coming into this week. Don't even focus on the SPY, the earnings. No, don't focus on none of that. Just focus on the bonds. If the bonds break down again and they hit 5% and they just start running from there, or they hold it or whatever, that you are looking at a potential short for the stock market. That is going to be your sign to go all in and say, I'm shorting this. But you don't want to do that just yet. I'm going to get into that a little bit in a different video. But just know the bonds are going to be your key to looking into the future. If you want to know whether you want to play the rally or not, you better hope the bonds rebound at least a little bit next week. But depending on how we're moving and the velocity that the bonds are moving at, it is not looking good. It is not looking good at all. And the bonds have been extremely oversold for the last 2 years. They have dropped 80% from their all-time highs from the last 2 years. They're in an extreme bear market, one of the worst bear markets for the bonds in history. So you got to keep that in mind, guys. The floor may still be underneath us, but we could still fall even more. And the fact that we're just punching through these interest rates this quickly is alarming, and it's telling us something in the economy is very sick, very ill, and we just don't see the problem yet. And also, this is causing a yield curve uninversion. I will get into that in another video too, but the yield curve is uninverting. Now, we all know what happens when the yield curve uninverts. Usually a recession is knocking and waiting to greet us. So with that being said, your main focus needs to be on the bonds, guys. Like I said, bonds. Don't even think about nothing else. Bonds. Watch TLT, watch TLH, all these bond ETFs. Watch the 10-year, 20-year, all of them. Watch it all. Nothing else matters but the bonds. All right. Now that I got that into your brain, let's talk about what's going on in the actual market. And our leader, which is, the real estate sector, I got out of this play because it contradicted my other plays. I got out of this, but maybe I should have held those because it hit $70, which was my strike price. So maybe I should have held those puts. Then again, it is what it is, right? You win some, you lose some, you cut early, you cut out, so it is what it is. But if you take a look at the real estate sector, it is selling off pretty aggressively, pretty aggressively. And if we can break this level right here, this little level right here, you're easily going back to 65. If you can't find support at 65, then it's just a free fall from there. So you got to keep that in mind. Real estate isn't looking good, so the real estate sector is slowing down. That could also be contributing to the SPY breaking down in the Russell 2000. Speaking of, the Russell 2000 has been getting absolutely demolished over the last couple of weeks. If we take a look at the Russell 2000, let me pull it up real quick. But yeah, if we take a look at the Russell 2000, they have been getting absolutely hammered, and I mean hammered. Even over the past year to date, it looks nothing like the stock market that we all see now. And this is related to the stock market. You know, take a look at the SPY yearly versus the Russell yearly. This looks nothing similar to the Russell yearly at all. It looks nothing similar. And why is that? Is because the Russell 2000 is more sensitive to interest rates, interest rate hikes. It is more volatile, all that sort of stuff. And on top of that, you don't have the Magnificent Seven carrying the entire stock market. This is what the market would look like if you didn't have these 7 stocks just absolutely carrying the stock market right now. They are putting on a masterclass performance. But like I'm saying, if you don't have this Magnificent Seven sitting in the stock market and propping up valuations, because if you take a look at the SPY, you may say to yourself, well, the SPY, you know, it looks different from the Russell 2000, but then take a look at the NASDAQ. The NASDAQ looks even more different than the SPY, and that's what I'm saying. There is a lot of differences between each of these stocks. Look at the NASDAQ. The NASDAQ looks even worse than the SPY. It's just huge spike all the way up to 14,000. Now, with that being said, if earnings comes in bad for the Magnificent Seven, we already got one, which was Tesla. Now we have Microsoft, you have Apple, you have Google. As a matter of fact, Microsoft and Google report on Wednesday, as well as Meta. So if you get those three and you get those 3 bad earnings, they are selling the entire stock market off. They're going to be getting sold off as well. But like I'm saying, there could be a stock market rally at the end of the year, so you got to be careful on when you want to enter these shorts. It could fall for another week or two and then bounce into November, going all the way into December, and then you will continue the onslaught of bad news, all this bad economic data, so on and so forth. But I just want to show you guys that the Russell 2000 is in a bear. It's been in a bear market since around 2021. It has been in a bear market, so you got to keep that in mind. We've been in a bear market for a while. It doesn't feel like it because you have the NASDAQ and the SPY just absolutely ripping faces off, only because of 7 companies. But if you take a look at the Russell, it is showing a different story. And even the Dow Jones looks different than the SPY and the NASDAQ. Take a look at the Dow Jones. You are still in this little chop area. You're actually below the August highs of last year, where we had the most hated rally. You're below that level. So to say that we're not in a bear market still is, kind of absurd to me. Maybe in the SPY and the NASDAQ, but if we're going to be fair, the Dow Jones and the Russell 2000 are still in bear markets. So I don't know. That's just me. I'm saying we're still in a bear market. All right, guys. So you got to be careful navigating this volatility, and it's interesting to see that the indices that are not holding as much tech heavy, as much heavyweight companies are getting sold off like crazy, and they're not even hitting their new highs. They're not even going close to the highs of the year. So you got to keep that in mind. We also have some economic data, so let's get into the economic data coming up. Microsoft, Google, Snap, Visa, Teladoc, all these companies, Texas Instruments, big companies reporting on Tuesday. I don't even want to get into Monday because Monday isn't really too much of what is going on, but Tuesday, Wednesday, and Thursday, look at all these companies reporting these 3 days. It is going to be a wild 3 days. There's going to be a lot of chop, a lot of volatility. So be prepared. All right, I wouldn't make any moves yet this week. You want to see if the move is going to be confirmed this week, because once again, you have so much going on that can affect the move that is going to happen. From earnings, you also have, again, bonds, and then you have the economic calendar. And if you take a look at here, Bank of Canada, you have Australia's interest rates, they're coming out. Inflation rate, I'm sorry. Australia interest rate, Canada, Canada's interest rate decisions coming up. Jerome Powell, that is going to be a big one. The stock market loves Jerome Powell. The ECB, you also have PCE coming into Thursday and Friday, PCE, and then you have consumer sentiment. It is going to be a jam-packed week, guys. This is the week where your dreams are going to be made or you are going to cry. So that is it, ladies and gentlemen. I hope you guys enjoyed the video. Like I said, be on alert for the bonds. This volume that we are seeing at these levels at 5% is unprecedented. All right, guys, you gotta be on alert. If the bonds drop any further and they keep running and they smash through these levels going from 5% to 5.25, you are going to have major problems, not only within the stock market but within everything, and it's looking like something is finally breaking, and it's just only a matter of time before we see it materialize in the real world. And as a matter of fact, ever since the bonds have been selling off this week too, materials and the real estate sector clobbered, absolutely clobbered. So maybe I should have held on to those shorts, but then again, only time will tell. I'm still bullish on the stock market as of now, but going into 2024, that is where I will be shorting pretty much everything. So besides the bonds, but we'll save that for another video. It is your boy Young Soros.